Kia ora, and welcome to the CoreLogic Property Market Update for Paenga Whawha, April 2024. The Aotearoa property market continues to see both real estate transaction volumes and values rise, but from a low base, with the number of home sales remaining below average and housing values 10.4% down from record highs in 2022. Nationwide, the monthly rate of growth lifted slightly to 0.5% in March, from 0.3% in February, taking the annual rate of change back into the positives at plus 0.1% for the first time since September 2022. Assessing performance based on the first 3 months of the year shows all main centres increased in value, albeit to a minor degree in Kirikiriroa Hamilton and Tauranga, which both saw small declines in March itself. Values across the wider Wellington area increased by 0.9% over the month and 1.6% over the quarter. However, there was clear inconsistency below the surface. This included relative strength in both Te Whanganui Atara, Wellington City, and Te Awa Kairangi Ki Uta, Upper Hutt, while at the same time values declined in both Porirua and Te Awa Kairangi Ki Tai, Lower Hutt. The granular Tamaki Makaurau Auckland data shows similar variability, with Rodney and North Shore comfortably outperforming the likes of Manukau and Papakura, while Waitakere, the Auckland City area, and Franklin all treaded water in March. Meanwhile, our largest two cities in Te Waipunamu, the South Island, saw similar growth to the nationwide figure, at around 0.5% over the month. Across the other main urban areas, the change through the first 3 months of the year has varied from minus 2.8% in Rotorua to growth of 2.6% in Waihopai and Vikago, 2.7% in Ahuriri Napier, and 3.2% on the Kapiti coast. The expectation of a relatively gradual, slow-moving recovery appears to be the order of the day across most of the country, as we shift even further towards a buyer's market, where potential buyers are spoiled for choice among the existing stock of listings on the market, and hold all the bargaining power, once they've secured funding of course. Vendors don't appear to be desperate either. Those higher serviceability test rates and lending restrictions through the value upswing period appear to be doing their job of ensuring stability in a time of vulnerability. The resilient labour market helps too. Some measures of credit arrears have started to increase, though part of it could be the usual lag following the Christmas-New Year period, and mortgage arrears remain well within comfort levels. While we're all hopeful to be past the worst of the interest rate adjustments, we should acknowledge there's still more to come for many. In all likelihood, there won't be any more increases to the official cash rate, or OCR, but some of the previous tightening is still to be worked through the system as existing mortgage holders refix their loans. This leaves the economy with further headwinds to face, as borrowers focus on servicing their debt obligations while spending less on discretionary or non-essential goods and services. The trade-offs continue though, and while a sluggish economy is not good news, this should also mean inflation continues to moderate, and the Reserve Bank can truly consider the idea of reducing the OCR, though I'd still not expect that until the end of the year at the earliest. The importance of this reduction can't really be understated, as affordability remains the greatest constraint on the market, and one that won't materially improve until interest rates fall, increasing consumer borrowing power and providing a boost to sentiment. It's largely for this reason we expect future value growth will remain muted and much more likely to align with income growth than we've seen in the past. That's despite the abundance of tweaks made to the property investment market by the government, on top of proposed looser loan-to-value ratio restrictions from the Reserve Bank. The reversal of a number of tenancy law changes, including reintroducing no-cause evictions and shortening eviction notice periods, adds to the numerous improvements for current and prospective landlords. But even totalling them up, they pale in comparison to the impact a reduction in interest rates would have. Perhaps the change being watched most closely is the shortening of the bright line test. There could well be a swell of investors keen to offload an asset with a negative cash flow, without the burden of any capital gains tax. Adding more properties for sale at a time of already high listings would further dampen any potential value growth. Longer term supply, as defined by total stock levels, will be impacted by the current weakness of the construction sector, and it remains an area of vulnerability. Dwelling consents continue to fall away, and it's now expected that completions or certifications are at or near peak, having worked through the full pipeline of previous activity. Given increased credit defaults and company liquidations already in the construction sector, it's an industry we need to remain wary of. The focus from government to promote competition by addressing some of the strict material regulations show they're aware of the challenges, but these changes will take some time to work through the system. The growth in the cost to build has already moderated, however, up only 0.5% in the first quarter of the year, meaning the annual rate of growth has slowed to 2.3%, well down on the recent peak of 10.4% per annum. More good news is required to lift confidence and certainty. For now, transactions appear difficult to achieve for both new and existing property. Despite a rapid rate of population growth, demand remains constrained by stretched affordability, and an increased supply from willing but not stressed vendors means reduced desperation from buyers. No wonder upwards price pressures are relatively mild. To stay on top of all the latest economic and housing market trends, be sure to follow our news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, X or Facebook. Don't forget to download our latest monthly chart pack and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.